Well, tēnā koutou katoa, welcome all to the news release for the official cash rate. The headline's already out, and as you know, the official cash rate remains at 1.75%. And we expect to keep the OCR at this level through 2019 and into 2020. As always, there are risks both upside and to the downside. Risks to the downside to our growth projections, upsides to our inflation projections. And as always, the timing and direction of any future OCR move remains data dependent. The pickup in GDP growth in the June quarter we saw was partly due to temporary factors, and business surveys continue to suggest growth will be soft in the near term. That's over the second half of this calendar year. Employment is around the maximum sustainable level. However, core consumer price inflation remains below our 2% target midpoint, and that necessitates us providing continued monetary support. GDP growth is expected to pick up over 2019, assisted by the monetary stimulus and population growth, underpinning household spending and business investment. Government spending on infrastructure and housing also supports this domestic demand. The level of the New Zealand dollar will also support export earnings. As capacity pressures continue to build, core consumer price inflation is expected to rise to the midpoint of our target range at 2%. Downside risks to the growth outlook do remain. The weak business sentiment could weigh more on growth for longer, and likewise trade tensions continue to remain in many major economies, and that raises the risks that trade barriers could increase and that can undermine global economic growth. To the upside, with regards to inflation risks, higher fuel prices are boosting near-term headline inflation. We will do our best to look through this volatility as appropriate. Our projections do assume that firms have limited pass-through of these higher costs into generalised consumer prices, and that longer-term inflation expectations remain anchored at the midpoint of our inflation target. We will keep the OCR at an expansionary level for a considerable period to contribute to maximising sustainable employment and managing low and stable inflation.
There's an old cliche in monetary policy that things work with long and variable lags, and so the key part of the question, I think, was yet. And just going back to the overall strategy, picking up a few threads of the questions, we cut interest rates back in 2016 with the intent of increasing demand above supply within the economy, both for goods and services and employment. Eventually, that increase in demand over supply would drive the inflation rate back to the midpoint. And we said, well, that's going to take roughly 2 years. That's the transmission mechanism, plus or minus a few months here or there. And so what we've been seeing with the unemployment rate and the increase in activity is what we hoped to see. That was what the plan was. And along that, we could stick to that plan as long as prices were being fixed towards the target. And as we monitor, so Adrian has picked up on inflation expectations, both 1 year, 2 year, and even 10 years are a little bit higher. They've sat pretty firmly around 2%. So eventually, firms think prices will increase on average across a range of goods and services at about 2%. And that's what we wanted to see. So this is, in terms of the outcomes for monetary policy, is pretty as good as it gets, really. We had a plan and it's working.
We love to worry, and there's a whole list of worries at the end of Chapter 2 in the document there, with ups, downs will remain the same across those sides, and any one of them is material on the outlook. Probably the real fat tail one in my mind is just if long-term bond yields rise for the wrong reasons rather than the right reasons, i.e. markets get spooked, start to demand a lot higher price for capital outside of anywhere other than the United States. And that is the type of balance sheet, sudden one-off 100, 200 basis point impact on balance sheets that lead to all sorts of very negative outcomes. So, we need to continuously be stress testing our banks, their funding ratios, their core liquidity, their capital ratios against those types of scenarios.